If the long-term rate is closer to 3.5 to 4% instead of 2%, first of all, let's start with is that a likely scenario that we need to adjust to? And then I'll ask part 2 of his question.
Yeah, I think it is a critical question to start to be wrestling with. I remember in this cycle when the short rate was at 2.5%, and Chairman Powell said it was highly, it was restrictive at 2.5%, and you looked at it and you're like, I don't think so, man. That you know,
Yeah.
and he was trying to back away at that. And, even at rates at 5.5, and in the high fours and through to the mid fives over the course of, basically, a year plus, growth has continued to be at or a bit above potential. And so you sort of look at that picture and you say, the overall sensitivity of the economy to the short rate, to the existing long rate structure, even with interest rates in the, between 4 and 4.5%, things are okay in the economy. And so what that highlights, I'd say on a tactical cyclical basis, that really raises a question of whether, there's enough tightening that exists on the short end to really slow things down meaningfully or quickly. I think the question on the longer term, which is what does that longer term neutral interest rate look like? I think part of it is, first of all, a lot of uncertainty. And, there'll be 7 academics in a room and you get 7 opinions about it and 7 highly quantitative models describing what's going on. So, we have to accept the ambiguity of it. But I would say, look, there's a lot of people who talked about a 2 or 2.5% rate back during the post GFC era where we had huge debt overhangs and in the private sector and depressed spending and incomes. That sort of story is not really pertinent to today. A lot of the healing has happened in the private sector in terms of the balance sheets. If anything, we're moving to an era where we're starting to get likely a lot more investment, part of it supported by the government and part of it, private sector driven to as a part of the deglobalization dynamic. So that's a draw for credit. And at the same time, the global savings glut has really stopped in a way that it had existed right after the GFC, where you had global central banks basically recycling liquidity into U.S. treasuries and into U.S. dollars. Places like China are more concerned with their currency going down than going up these days. And so you basically have this situation where probably the demand for capital on a forward-looking basis is meaningfully higher than where it was back in the post-GFC period. The supply of capital is probably lower. And we've got this, this inflation issue, which we at least have to acknowledge is more of an issue today than it was, 10 years ago when people were more concerned about deflation. You put that all together and probably the sort of baseline level of interest rates that you're seeing is probably going to be higher, certainly than 2.5, which is where we were for the last 15 years.